Did you know that a blindfolded monkey throwing darts at a newspaper could pick stocks just as well as the experts on Wall Street? It sounds like a joke, but it's a claim made by some of the most famous economists in history.
If you've ever felt like the stock market is a rigged game or a confusing puzzle, you aren't alone. Today, we're looking at the invisible hand that controls every price you see on your screen. We're talking about the efficient market hypothesis. Understanding this one concept is the difference between gambling your savings and building a steady, slow source of wealth. Let's dive in.
At its very heart, the efficient market hypothesis, or EMH for short, says that the stock market is efficient. But what does that actually mean for your wallet? It means that every single piece of news, every earnings report, every CEO tweet, and even every whisper of data is already baked into the price of a stock. Think about it like this. There are thousands of brilliant people with PhDs and supercomputers sitting in glass towers in London and New York. Their only job is to find information and trade on it instantly. Because they react so fast, the price you see right now is usually the fair price. If the theory is right, you can't beat the market because there are no bargains left to find. It's like trying to find a $20 note on a busy sidewalk. If it were really there, someone would have picked it up before you even turned the corner.
Now, I know that sounds a bit depressing. You might be thinking, if I can't find a bargain, why even bother? But stay with me, because understanding why the market is hard to beat is actually your secret weapon to winning. Imagine this jar. If I ask one person to guess how many beans are inside, they'll probably be way off. But if I ask 1,000 of you and take the average of those guesses, the result is almost always remarkably close to the truth. The market is that group of 1,000 people. It's the collective wisdom of millions of traders. Every time someone buys or sells, they are guessing the value. The current price is just the average of everyone's best guess.
So, does the data back this up? Some of the evidence is really staggering. Over a 10 to 20-year period, roughly 80% to 90% of professional fund managers, the Goliaths with the best computers and the biggest offices, fail to beat a simple, low-cost index fund. Why? Because news travels at the speed of light. By the time you hear a hot tip, the market has already reacted, the empty seat in the front row is taken, and the price has adjusted.
I know what you're thinking. What about the 2008 crash? What about the 2020 wild swings? The market isn't perfect. Human emotion, fear, and greed can drive prices crazy in the short term. Critics like Robert Shiller, another Nobel winner, argue that markets are driven by irrational exuberance, not just data. Statistically, stock prices jiggle much more than the actual earnings of the companies they represent. This excess volatility is proof that we aren't always rational actors. There are even market anomalies, like the January effect, where small stocks tend to rise at the start of the year simply or tax reasons, not news or great results.
But here's the hard fact. Look at this chart. The jagged red line is the noise. It's the daily hype, the emotional reactions, and the random walk that you can't predict. The smooth gold line, that is the signal. That's the long-term growth of company earnings. In the short term, the noise is random, but in the long term, the noise always follows the signal.
So if you're a non-expert investor looking for a steady, slow source of income, what's the winning move? One strategy is don't look for the needle in the haystack. Just buy the haystack. By using low-cost index funds, you join the market instead of trying to outsmart it. You accept the market's return, you avoid high fees, and you benefit from the collective wisdom of millions. This is just one chapter of the story. In our new book summary, it consolidates the best insights from our first 30 videos into one high-level manual, complete with much more in-depth explanations you won't find on this channel. It's designed to be the definitive resource for your library. The link is below in the next video when we talk about the dot-com crash and treasury bonds. I'll see you then.